Hello and welcome to the JAFX YouTube channel. My name is Jordan, and on today's video we'll be briefly looking at and touching upon supply and demand. What it is, why hedge funds, institutions, banks, super banks, why all the major players in the game like to use it, and then if there's enough time we can create a simple strategy to help the retail trader, i.e. you watching this video now, how to adapt this to your daily arsenal so you can trade and become more profitable, hopefully. So if we move over to the chart now, you can see that I'm on the gold chart, on the daily chart. So every one of these bars here is worth a day of data. We're using the bar replay feature here. So I'm currently on 10th of September 2020. To give you a quick rundown of price and what's happening, price made this high here, came all the way up, went all the way down, and then created this large wicked bodied candle here. So if I just get my rectangle tool out and just draw a rectangle over the bottom of this basing candle here. So essentially what's happened is price came all the way down to here. This was just a big bearish candle at one point, a massive red candle. Price got to here and in this zone here, and then as I said before, the major players in the game, the whales, the banks, institutions, multi-billion-dollar hedge funds, everything like that, decided price was really good when it got to here, so they thought, alright, that's a really low price compared to what it has been, we're going to buy it, buy loads of it, and that's exactly what's happened. Price then skyrocketed all the way back up. I'd say this price went all the way back up 1,470 pips all the way back up. So that was a massive trade. That is major money in the game. I also trade with volume. So I have a volume indicator on my MT4 and MT5 app, which shows when the massive money is entering and leaving the market, in essence, to help my trading as well. So if we look here, it's obviously made a base here. So all we're doing is waiting for price to get back to this base. It can take as long as it takes. It can be as quick as it is. So it has reached the base now, or the demand, but it's also got to the demand with a very quick push from the upside. So you can see that push from the upside took 5 days to get all the way back down to correct that full move that happened there as well. So now we've got our supply level up here and our demand level down here. I don't take a trade unless it's in either of these areas. You can mark them off with a horizontal ray or with a grey box. I tend to do the grey boxes in daily, the horizontal rays, as you will, on the 4 hour, and then the 1 hour gets grey boxes as well, and then anything less than the 1 hour, so the 30, 15 and 5 is due for just entries and entries only. So now price is in this key level here. It's created a bullish doji, which is a reversal pattern, sorry. So we'd expect price to come all the way back up to our supply level here, and then come all the way back down to our level here, and just creating a range in essence between our supply and our demand vectors. We've got a lot of wicks in this area here and a lot of price movement in this area here, so we could see price struggle a little bit here, but ultimately the longer weekly, monthly trends will prevail in sense. So let's get rid of this, and then if we play one more. So it's a bearish candle. I'd like to see price obviously come up. So if we create our stops just below the daily candle, the daily low, target just before that resistance line, sorry, just before that supply box and line. And then if we play the bar feature, so we entered the market there, price consolidates, moves elsewhere. We're not interested, we just want it to come up to the supply level. So it comes to retest the base and the demand again, and when it does do that, it again skyrockets up, hopefully. Yeah, alright. So that would have been a nice 4.75 trade there. We close that off, we'll just put that there, and then again extend this out, and then I would argue this exactly the same is going to happen. So just put a stop loss just above the box. Wow. Okay, so we would have been entered into that. We would have not been stopped out in this example, but might have been stopped out in a real life example with spreads and everything like that. But that was a massive, massive, massive bearish candle, and we slapped an 8.8 risk to reward on that one there. Meaning that across both of our examples that we demonstrated and laid out in this video, we'd have hit a 13.55 risk to reward ratio. That's if we was risking 1% per trade, but if we was risking 2% per trade like I typically do, we'd have had a 27.1 risk to reward ratio and 27% gains on our capital. That is incredible. It doesn't normally happen, so we've got to take these wins when it does happen. Essentially, all you have to do is, if price comes down to a demand area, wait for a bullish candlestick pattern and buy it. If price comes up to a supply level, wait for a bearish candlestick pattern and sell it. I know it is a lot harder than that typically, but we are paid to wait, so if we wait for the right setup, we will get the money. My name is Jordan. This has been a supply and demand video. Please like, comment and subscribe, all of the YouTube algorithm jazz, and I will see you again for a new video. Take care and peace, people.